Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sumaira Abdi. Good morning, Sumaira. That's complete risk off that you can see across the Indian market screen and the global market screen. Right now, the Nifty is managing to defend that 17,000 mark. We went very close to that level. The low today is 17,003. We managed to climb about 10 to 12 points above that level. But as you can see, very precariously poised. We're currently down 1.8% on the benchmark indices. The advanced decline ratio has one stock in the green for nearly 18 in the red. The key level to track will be the 200-day moving average. As I said, so far at least, we've managed to defend that level. 16,993 is where that's positioned. It's only a handful of IT as well as FMCG stocks which are currently in the green. So if you look at the Nifty gainers plate, you would see some Nestle, a Britannia, a couple of IT names like HCL Technology, as well as Infosys, which make it and are currently holding up in the green. On the losing side, many of the companies which have a global exposure. So say a Tata Motors, especially to the pound, where we've seen a very sharp depreciation in the pound. You've got a Hindalco, a Tata Steel. These are all global plays, commodity links. So there are a lot of global linkages over there. And these are the stocks which are under pressure. The big two cues for the week for the Indian markets, one will be the expiry on Thursday. And then on Friday, we've got the RBI policy. But till then, the focus will squarely be on what's happening in the global markets and the currency volatility, the foreign currency mayhem and volatility that we've seen. Hi.
Hi, Reema. Morning. So let's get started. We'll first begin by focusing on the global picture. Nifty and Sensex have tumbled amidst a global sell-off, broad-based selling, battered equities. Realty, metals, auto are all taking a hit. Bears look to be firmly in charge. Mid-caps are also taking it on the chin. To talk about what's happening in the global market and how it's going to impact our own market, Richard Harris, Chief Executive of Port Shelter Investment Management, will join us in just a short while. In a bit, we'll also be joined by Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, to talk about the Indian market, the top sectoral bets, where to look for opportunities here. And a little later on the show, Indian immigrants in the US on a work visa are grappling with long waiting time and appointment delays. The average appointment time has in fact now gone up to well over 700 days, which means a 2-year wait just to return home. Shivendra Singh, Vice President and Head of Global Trade Development at NASSCOM, will join in to talk about what this means in terms of impact. All of this and much more lined up over the next 60 minutes.
But first up, let's talk about the markets. We've got Richard Harris, the Chief Executive Officer at Port Shelter Investment Management, now joining in to talk about the mayhem that we're seeing in the currency market and how that spooked global equity markets as well. Richard, this has been a very tough year for, equity markets and investors in general. Generally, when equities go south, you make money in the bond markets. But this time, you're losing money in equities as well as bonds. Look at the way the U.S. markets have sold off year to date. We're down close to about 20% on the Dow, on the S&P 500. The Nasdaq is down 30% on a year-to-date basis. And now the big talking point is, are we going to breach the June lows? Because the U.S. markets, the indices there are holding up above those June levels by just about 1.5% thereabout. What have you made of what we are seeing currently in the global scene now in terms of currencies and equities?
Well, in some ways, it's not surprising if we are looking at coming into a global recession, and increasingly observers are looking at that. Then I think, yes, it's not an entirely surprising reaction. Don't forget that since COVID, we've had some extraordinary rises in the equity markets. Inflation remains stubbornly low. The bond market has held on strongly. But I think now we're in a situation where maybe the dam has burst. And the biggest example of that, of course, is the UK, where for too long they played fast and loose with economic policy. And I think the market's now starting to punish them.
Hi, Richard. So, the point is that in all of this mayhem, investors still have to invest, right? So where is the opportunity now? I mean, which are the markets which are looking attractive to you? Which are the asset classes which are looking attractive? I mean, is it time to sort of, be hiding in safer asset classes, or is there an opportunity amidst this crisis?
Well, it is a situation, you can't run and you can't hide, except maybe in cash. And then at the moment, you're looking at US dollar cash. And I think this is what the markets are telling us. If we're looking at the trends at the moment, people want dollars. They don't want equities. bonds are going the wrong way because inflation's going the wrong way. Central banks have been far, far too slow, purely reactive, coming far too late in the game, and assuming that we're going to see rosy weather when clearly we were not. The markets are ready for a tumble. We've had central banks now for maybe 10 to 12 years look to support markets when things have got a little bit tricky by printing money. Now we're in a situation where eventually they have to face the music. The Fed, to be fair, is facing the music. We're looking at interest rates maybe going up quite strongly now to control inflation. But I think many other countries, Japan is one, the UK is one, where they still think rosy weather is ahead, where we're looking at growth. So investors really have to batten down. And I think in the short term, cash is the safe haven. In the longer term, we will see other assets, inflationary sensitive assets, those companies that can raise their revenues during a time of inflation, they will do okay. We'll see real assets do okay. But at the moment, I think really we're looking at a cash environment.
Okay, so cash is perhaps the most attractive asset right now. Richard, you said markets are ready for a tumble. What exactly did you mean? How much lower do we go from here on? And can you break that up in US markets as well as India? Because India has been outperforming.
Yes, it's difficult to say. I mean, India has been outperforming. I think it probably will continue to do so. If you've got your money at home, that's fine. But then, of course, you want to have some US dollars because the dollar is king at the moment. So it's not all plain sailing. We are facing a recession. We're facing a situation where the air is coming out of the markets. And remember that markets are really a balance between willing buyers and willing sellers. There's got to be a lot of confidence in there. And if confidence starts to fade away, then, of course, you're going to get a generally lower market level. And I think that's what markets are doing now. They're looking for where is that particular level. It probably is lower than here. Very difficult to judge exactly where it will go. But I think we're in a situation where the markets do have to have a taste of difficult medicine in order to find a new and more fundamental level.
Just one question. You said Indian markets will continue to outperform. So for Indian investors, right, not the US investors, the local investors who are investing in rupee and they're going to get their cash back in rupee as well, does it make sense to move into a cash position or should they continue to hold on?
Well, I think it's the same thing. I mean, your market's down a reasonable amount today. We're not really in an environment where investors need to think this is good value. We're in an environment where the air is generally coming out of the market. Now, you can take the view that, I'm going to stay in a portion of equities. And I think that's a very respectable view because equities will continue to come through. So what investors have to do is keep in their mind the J curve. We're going to go through a period when the markets are going to go down, when cash is king. But you don't want to be there forever because equities do reasonably well in times of inflation. You also get gold doing better than it should. You also get real estate doing better because real assets are priced in non-inflationary rupees, non-inflationary dollars. So as always, it's best to have a mix of assets so that it's not a call to come completely out of equities, for instance, but we're just looking at lower levels all round of risk assets and higher levels of cash.
So, Richard, now that the situation of possibly a hard landing is becoming the base case for a lot of people, right? Given that setup, what will be the future triggers which will be important for investors to monitor?
Well, you see, the triggers are what we call unknown events. You don't really know what they are. I think at the moment, if you have relatively stable politics, geopolitics, of course, is not secure at the moment, but we seem to have reached a steady state. We're likely to see some of the growth come out of the main Western markets, which, let's face it, are often the driver of the global economy. So as I said, because we're doing that, that's why we're seeing this kind of reaction in risk assets. But looking global ahead, as I said, it's wrong to be ultra bearish. It's certainly wrong at the moment to be bullish. The bias is on the fact that the markets are likely to come down. And I think that's the situation investors need to think of having more cash and less equities in a balance.
And what have you made of the turmoil that we're seeing in the foreign currency market? You spoke about how UK has had its policy too fast, too low, and now perhaps the dam is burst. And we're seeing that getting reflected in the sterling rate. Sterling is now hit a fresh low against the dollar. And if euro's gone to parity, perhaps the sterling may also be heading towards that level. Your thoughts on what's happening in the currency market?
Well, it is extraordinary, isn't it? We could see the dollar, the pound, and the euro worth the same value in a few days. And that, of course, has never happened. I think the issue with the pound is that it's really very isolated. It's got policies that clearly are not working. The pound was slightly more protected when Britain was in Brexit, when Britain was in Europe. But after Brexit, of course, the pound has no friends. The Japanese yen is in a similar sort of position. The central bank has refused to increase interest rates. And as a result, the yen has been hard hit and the market has been hard hit too. At the moment, you really have to follow the kind of policies that everybody else is following. Tick interest rates up when interest rates are going up elsewhere. Be careful of your inflation. Don't come out with anything particularly new, because if you do, the market's going to punish you.
All right, Richard, thanks very much for your time today. And we look forward, of course, over the next few days and weeks to touch base with you once again. For now, we're going to take a quick break. And up next, we'll talk about what's buzzing in the commodities space. Manisha will be with us. Stay tuned.